Hey everyone, welcome back to Corporate Dakota, the place where we find the juicy details in those dry corporate reports. Today we're digging into Denny's latest quarterly report, and let me tell you, there's a lot to chew on. Their financials are showing some interesting shifts, and we're going to decode exactly what that means for your favorite breakfast spot. And hey, if you want to stay ahead of the curve on these kinds of financial breakdowns, make sure you're subscribed and join our community over on Discord. The link is in the description below. Alright, let's dive straight into the numbers for the quarter that ended June 25th, 2025. Looking at their balance sheet as of June 25th, 2025, we see total assets standing at around $491 million. This is a slight decrease from December 2024. What's interesting here is their cash position, which went from about $1.7 billion down to $1.1 billion. They also had investments worth a bit over $1 billion in December, which are now gone. This could mean they used that cash for other things like investments or maybe paying down debt. Liabilities are also down slightly to about $525 million, down to $1.1 billion. They also had investments worth a bit over $1 billion in December, which are now gone. This could mean they use that cash for other things like investments or maybe paying down debt. Liabilities are also down slightly to about 524. What's interesting here is their cash for other things like investments or maybe paying down debt. Liabilities are also down slightly to about 500 periods of investment, but it's still something to keep an eye on. Now let's move on to the income statement for the quarter. Total operating revenue was about $100 company restaurant sales. Those are the ones directly owned by Denny's, actually went up by about $4 million to $58.4 million. Franchise income, on the other hand, went down slightly by about $2.3 million to $59.3 million. Franchise income, on the other hand, went down slightly by about 4 franchise locations, or that 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 franchise locations aren't growing as fast as company-owned ones, $3 million to $59.3 million. This might suggest they are selling off more franchise locations, or that franchise locations aren't growing as fast as company-owned ones might. Looking at comprehensive income, we see a net loss for the quarter of about $157,000. Last year for the same quarter, they had a positive comprehensive income of over $4.6 million. This change is largely driven by a significant drop in the fair value of their cash flow hedges, which also went from a positive $2 million to a negative $2.6 million. This means that some of their financial instruments meant to protect against interest rate changes are currently costing them money on paper. Switching gears to the shareholders deficit section, we can see how their equity situation is changing. For the quarter ending June 25th, 2025, their common stock amount is pretty stable, but paid-in capital, which is money invested above the par value of the stock, increased significantly to $4.2 million. Retained earnings, however, are still in deficit, a small negative $2.5 million, compared to a larger deficit last year. What's also notable is that they bought back treasury stock worth about $1.6 million, effectively reducing the number of shares outstanding. Onto the cash flow statement for the 2 quarters ending June 25th, 2025. They had about $14.3 million in cash from operating activities. This is pretty much the same as the prior year. However, their investing activities used up more cash this year at $17.5 million compared to about $10 million compared to about $10 million compared to about $10.5 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 million compared to about 10 forfeit fidya. Let's dip into the notes to understand what these numbers really mean. They operate 2 main brands, Denny's and Keke's Breakfast Cafe. As of June 2025, they have over 1,500 restaurants in total, with Denny's being the vast majority. When we look at receivables, which is money owed to them by customers and franchisees' trade accounts, receivable from franchisees are around $13.5 million. This is down from nearly $16 million in December. Vendor and credit card receivables have also decreased significantly. This could indicate faster payments from customers or fewer sales through these channels. Goodwill, which represents the premium paid for acquisitions, has actually increased a bit to $68.5 million. This is primarily from acquiring more Keke's franchise units. Their intangible assets like trade names and franchise rights remain substantial at nearly $98 million. Amortization expense for these definite life intangibles is quite low, so it's not a major hit to their income. This note talks about how they value certain assets and liabilities that fluctuate with the market. Their deferred compensation plan investments are valued at $10 million and are considered safe as they are in active markets. Their interest rate swaps, however, are valued using more complex models and are worth about $11.7 million. These are the same hedges we saw impacting their comprehensive income earlier. Now let's talk about debt. They have a senior secured revolver worth $400 million maturing in August 2026. As of June 2026, as of June 2025, they have borrowed $268.6 million. This constitutes a significant portion of their debt. What's interesting is their use of interest rate swaps. These swaps effectively turn most of their variable rate debt into fixed rate debt. This is a smart move in a rising interest rate environment as it provides more certainty on their interest payments. Here we get a breakdown of their revenue. Company restaurant sales are about 49% of the total, and franchise and license revenue makes up the other 51%. In terms of trends, royalties are down from the previous year, and advertising revenue is also down. This again points to a potential slowdown in franchise growth or fewer new franchise openings. Initial and other fees are up though, partly due to equipment sales to franchisees and an early franchise termination fee, which is a one-off gain. This section details various one-off or unusual items. Impairment charges are higher this year, particularly related to closed franchise restaurants and relocating some of their support functions. Restructuring and exit costs are also up mainly due to severance payments from eliminating positions as part of a cost-saving initiative. These expenses weigh on their profitability. Share-based compensation is a big cost here. For employees, they granted performance share units and restricted stock units totaling about 2.3 million units with a fair value of $6.73 per restricted stock units. This means a significant portion of their pay is tied to company performance and stock value, effectively making employees shareholders. For the board of directors, they also granted restricted stock units. This means a significant portion of their pay is tied to company performance and stock value, effectively making employees shareholders. For the board of directors, they also granted restricted stock units. This means a significant portion of their pay is tied to company performance and stock value, effectively making employees shareholders. For the board of directors, they also granted restricted stock units. This means a significant portion of their pay is tied to company performance and stock value, effectively making employees shareholders. For the board of directors, they also granted restricted stock units. Their income tax rate is quite high this year at 34.3% for the quarter and 36.2% year to date. This is significantly higher than last year's rates. The increase is mainly due to positive tax adjustments related to share-based compensation, which create a temporary tax benefit. They're also assessing a new tax bill which could impact them further. Net income per share is showing a decrease. For the quarter, it's down to 5 cents per share compared to 7 cents last year, and for the year to date, it's 5 cents compared to 16 cents. Diluted earnings per share also reflect this trend. The number of shares outstanding is also slightly down due to share repurchases. We saw earlier that their shareholders' deficit is negative. They have a share repurchase program, allowing them to buy back stock. They've repurchased 400,000 shares for $1.6 million in the year to date, which reduces the number of shares outstanding and can boost earnings per share for remaining shareholders. The accumulated other comprehensive loss has widened, which is mainly due to unfavorable changes in their cash flow hedges. Now let's look at their segments. Denny's is their main business and Keke's is their smaller segment. Denny's company restaurants saw a slight decrease in units, while Keke's company restaurants increased. Same-store sales for Denny's are down slightly, both company-owned and franchise locations. Keke's, on the other hand, is showing positive same-store sales growth for both company-owned and franchise restaurants. This indicates Keke's is a growth driver while Denny's is facing some headwinds, specifically for company restaurant operations. Denny's same-store sales were down, but Keke's same-store sales were up significantly. That 3.4% increase in the quarter for Keke's is a bright spot. However, their overall costs of company restaurant sales as a percentage of revenue have increased. Product costs are up mainly due to higher egg prices, which is a common issue in the industry right now. Franchise operations saw fewer Denny's locations and a drop in royalties. This again suggests a slowdown in franchise expansion for Denny's. Keke's franchise sales are growing, though, which is positive. The costs associated with franchise operations also decreased, which helped offset some of the revenue decline. General and administrative expenses went up slightly this quarter. This is primarily due to increased share-based compensation for employees and higher incentive compensation recognizing good performance. Looking at liquidity, their cash flow from operations remains stable, and they have a significant amount of borrowing capacity on their credit facility. They are investing heavily in new technology and restaurant upgrades, which is good for future growth. Now for my take on Denny's, they are navigating a tough economic environment with rising costs, especially for ingredients like eggs. The slight decline in Denny's franchise business is a concern, but the growth at Keke's is a positive sign. They are smartly using interest rate swaps to lock in borrowing costs, which is good financial management. However, the increased restructuring costs and the widening shareholders' deficit are things to watch. They need to convert that investment in Keke's and new technology into profitable growth to really turn things around. It feels like they are in a transition period focusing on efficiency and strategic growth. Alright, that's our breakdown of Denny's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.